The Dividend ETF everyone's buying just posted negative returns. While the market surged 15%, this safe income play lost money. And there's an alternative delivering 10.98% gains in the same period that nobody's talking about. Most income investors are about to miss the biggest shift in dividend investing since 2020. Because while everyone's chasing yield, they're completely ignoring what actually drives long-term wealth in dividend portfolios. The evidence is already here. One overlooked ETF delivered 94.40% returns over 5 years. Another pays 4.52% yield monthly instead of quarterly. Both are crushing the popular choice everyone recommends. But here's what really caught my attention. Harry discovered something shocking in his portfolio review last month. The Dividend ETF everyone told him was essential became his worst performer. Meanwhile, 3 alternatives he'd never considered were printing money. That revelation changed how he thinks about income investing completely. Today, I'm exposing 4 dividend ETFs positioned to potentially dominate through 2030. We'll uncover the growth monster hiding behind a boring name, the monthly income generator revolutionizing cash flow, why the popular choice might be a value trap, and the exact portfolio construction for maximum wealth building. This is educational content only. All investments carry risk, and past performance doesn't guarantee future results. Always conduct your own research before investing. Because here's the truth about dividend investing nobody admits. Yield is yesterday's game. The real money comes from dividend growth rates. Think about this carefully. A 4% yield today sounds attractive. But if that dividend never grows, inflation destroys your purchasing power every single year. After 5 years of 3% inflation, your real yield drops to 2.8%. After 10 years, you're barely breaking even. Meanwhile, a lower-yielding ETF growing its dividend at 9% annually? That's where compound magic happens. Let me show you the math that changes everything. Start with our first alternative that's rewriting the dividend playbook. VIG, the Vanguard Dividend Appreciation ETF. This isn't your typical dividend fund. With $112.64 billion in assets under management, it's become the stealth wealth builder of income portfolios. The yield is just 1.64%. Most investors scroll right past it. That's their expensive mistake. VIG gained 9.98% in 6 months. The 5-year total return? 86.12%. These aren't random numbers. This is systematic outperformance driven by one factor: quality growth. Look at the holdings. Broadcom commands 5.95% of the portfolio. Microsoft sits at 4.83%. Apple at 3.74%. These aren't dying value plays hoping for revival. These are companies growing earnings, expanding margins, and raising dividends from strength, not obligation. The dividend growth rate tells the real story. VIG's 5-year growth rate runs at 9.60% annually. Compound that forward. In 5 years, today's 1.64% yield becomes 2.6% yield on cost. In 10 years, you're looking at 4.1% yield on your original investment. But that's just the dividend story. The price appreciation devastates high-yield alternatives. VIG's 3-year return hit 63.43%. The 10-year return? 253.40%. Harry calculated what $50,000 invested 10 years ago would be worth today: $176,700. From a low-yield ETF, the expense ratio seals the deal, just 0.05%. You're paying 5 basis points for institutional quality portfolio management. That's less than most people lose to bid-ask spreads. Harry started moving money here 6 months ago. His only regret? Not starting sooner. Because while VIG dominates growth, another ETF found the perfect balance. DGRO, the iShares. Core Dividend Growth ETF. This is where investment strategy gets sophisticated. DGRO yields 2.05%, higher than VIG, but still modest. The magic happens in total returns. 5-year performance, 94.40%. That's not incrementally better. That's category-defining performance. The secret is selection criteria. DGRO doesn't just buy dividend growers. It screens for quality metrics, consistent earnings, strong balance sheets, sustainable payout ratios. The result? A portfolio of companies that raise dividends because they can, not because they must. Apple leads at 3.11%. JP Morgan matches it. ExxonMobil at 3.02%. This isn't random selection. This is strategic positioning across sectors that drive economic growth. Technology for innovation. Financials for capital allocation. Energy for inflation protection. The numbers validate the strategy. 10-year returns, 253.33% total return. The dividend grew consistently for 10 consecutive years. Even during COVID, DGRO maintained and raised its payout. Harry calls this his sleep well allocation, because DGRO captures growth without sacrificing stability. The expense ratio? 0.08%. For 3 extra basis points over VIG, you get higher current yield plus similar growth. That's optimization at its finest. The compound interest effect becomes dramatic over time. Calculate forward. $100,000 in DGRO today, assuming historical growth rates continue, could become $350,000 by 2035. The dividend income alone could reach $10,000 annually. That's retirement planning with mathematical precision. But DGRO's real advantage appears during volatility. When growth stocks crash, DGRO's value tilt provides cushion. When value lags, its growth holdings carry performance. This isn't luck. This is thoughtful asset allocation within a single ETF. Which brings us to the dividend champion everyone knows. SCHD, the Schwab U.S. Dividend Equity ETF. SCHD built its reputation on simplicity, high yield, low cost, quality screens. The 3.83% yield attracts income seekers. The 0.06% expense ratio keeps costs minimal. With $70.59 billion in assets, it's become the default dividend choice. But defaults can become traps. Look at recent performance. 6-month return, negative 2.26%. 1-year return, negative 2.09%. While markets surged, SCHD stumbled. This isn't temporary bad luck. This is structural challenge. The problem? Concentration risk. Energy comprises 19.75% of holdings. Consumer defensive adds 18.63%. When oil prices fluctuate or consumer staples lag, SCHD suffers disproportionately. The current environment punishes both sectors. The 3-year comparison reveals the cost. SCHD returned 33.95%, while VG delivered 63.43%. On a $200,000 portfolio, that's a $60,000 performance gap. That's not rounding error. That's retirement timeline difference. Harry kept SCHD for years, assuming safety. Then he studied the holdings. Altria Group facing declining cigarette sales. Verizon struggling with infrastructure costs. These aren't growth stories. They're value traps with dividends attached. The 5-year return still looks respectable at 79.25%. But compare that to DGRO's 94.40% or VIG's 86.12%. SCHD consistently underperforms while taking similar or greater risk. This doesn't mean SCHD is worthless. It means it shouldn't be your only dividend play, or even your largest. Because while SCHD struggles with quarterly payments, another ETF revolutionized income distribution. DIVO, the Amplify Enhanced Dividend Income ETF. DIVO solves the problem nobody discusses: dividend timing, monthly payments. Every single month cash hits your account. The yield? 4.52%, higher than SCHD, paid 12 times annually instead of 4. Harry discovered this during retirement planning. Quarterly dividends create cash flow gaps. Monthly payments match monthly expenses. It's simple but transformative for financial planning. But DIVO isn't just about payment frequency. The strategy generates premium income through covered calls. When stocks trade sideways, DIVO collects option premium. When volatility spikes, premiums increase. It's passive income that adapts to market conditions. The 5-year return surprises skeptics, 90.07% total return. DIVO beat SCHD while paying higher yield more frequently. The 3-year return of 56.86% demonstrates consistency across market cycles. The holdings explain outperformance. Apple at 5.40%, Microsoft at 4.94%, Visa at 4.88%. These aren't traditional income stocks. They're growth companies with DIVO overlaying income strategies. Harry allocated $30,000 to DIVO 6 months ago. The monthly payments already changed his cash flow management. No quarterly waiting, no dividend droughts. Just consistent monthly income averaging $113. The expense ratio is higher at 0.56%. But for monthly payments, covered call premiums, and downside protection, Harry considers it bargain pricing for income optimization. During market corrections, DIVO shines brightest. The covered call premiums provide cushion during drawdowns. When SCHD drops 10%, DIVO might drop 6%. That difference compounds over multiple corrections. Now here's where strategic construction becomes critical. Because choosing one ETF is amateur thinking. Professional wealth building requires thoughtful combination. The synergies between these ETFs create portfolio dynamics that single holdings can't achieve. Consider the correlation matrices. VIG and SCHD have 0.65 correlation. DGRO and DIVO show 0.71. These aren't perfectly correlated. They zig and zag at different times, smoothing overall returns while maintaining income growth. Harry's evolved allocation reflects this understanding. 35% to VIG for growth leadership. The technology and healthcare exposure captures innovation trends. 30% to DGRO for balanced growth and income. The diversification across sectors provides stability. 25% to DIVO for monthly income and volatility premium. The covered call strategy adds non-correlated returns. 10% to SCHD for value exposure and higher yield. Even underperformers have roles in diversified portfolios. This isn't random weighting. This is mathematical optimization based on historical correlations, forward growth projections, and income requirements. The combined portfolio yields approximately 2.5% currently, but apply weighted average dividend growth rates? The yield on cost reaches 4% in 5 years, 6% in 10 years. Meanwhile, capital appreciation compounds dramatically. Harry modeled this allocation using historical returns. Starting with $300,000 today, the projection for 2030 shows $580,000 portfolio value with $23,000 annual dividend income. Using SCHD alone? Maybe $450,000 with $17,000 income. That $130,000 difference? That's years of additional retirement security. That's legacy wealth for the next generation. That's the cost of single ETF dependency. The implementation strategy matters as much as allocation. Don't rotate everything immediately. Market timing destroys returns. Instead, Harry uses the quarterly rebalance method. Every 3 months, he moves 5 to 10% toward target allocation. This captures dollar cost averaging benefits while minimizing transaction costs. Tax efficiency requires consideration too. Hold SCHD and DGRO in tax-advantaged accounts where possible. Their higher yields generate more taxable income. VIG's lower yield and higher appreciation work better in taxable accounts where capital gains receive preferential treatment. The psychological benefit can't be ignored either. Watching monthly DIVO payments arrive provides confidence during market volatility. Seeing VIG's growth during bull markets satisfies appreciation desires. DGRO's balance prevents extreme swings either direction. Harry learned this during 2022's correction. His single ETF friends panicked. His diversified dividend portfolio. It kept paying, kept growing, kept compounding. The emotional stability enabled rational decision-making when others sold at losses. Looking toward 2030, the macro environment favors this approach. Interest rates stabilizing benefits dividend growers. Technology disruption rewards quality growth holdings. Demographic shifts toward retirement increase. Demand for income solutions. These ETFs position perfectly for these trends. The Federal Reserve's stance matters less when you own companies raising dividends regardless of rate cycles. Inflation becomes manageable when your income grows faster than price increases. Market volatility transforms from threat to opportunity with covered call strategies. Harry's conviction grows stronger each quarter. The dividend checks keep arriving. The account balances keep climbing. The strategy keeps validating itself through performance. Because ultimately, successful investment portfolios aren't built on single solutions. They're constructed through thoughtful combination of complementary strategies. These 4 ETFs provide that combination. VIG captures growth. DGRO balances considerations. DIVO generates consistent income. SCHD adds value exposure. Together, they create something greater than individual components. A portfolio engineered for total return. An income stream that grows regardless of market conditions. A financial future built on mathematical probability rather than hope. The path to 2030 wealth isn't complicated. It just requires looking beyond conventional wisdom, beyond the default dividend choice everyone recommends, beyond the yield obsession that blinds investors to total return, beyond the single ETF simplicity that sacrifices optimization for convenience. Harry made that shift. His portfolio thanks him monthly. The question isn't whether these alternatives can crush SCHD by 2030. The math already answers that. The question is whether you'll act on this information while there's still time to compound the advantage. Because every quarter you wait is another dividend payment at suboptimal allocation, another growth opportunity missed, another step behind where you could be. The tools exist, the data supports it, the strategy is proven. Your wealth-building journey for the next decade starts with this decision. Choose wisely, choose growth, choose diversification, choose to crush it by 2030.